with all student loan questions, that's why I love student loan planning. It really brings in numerous parts of the financial plan, just in case something changes, and likely something will likely change a little bit. We're keeping an eye on it. Best breaking news, likely Tyler's Twitter. We'll definitely be on top of that.
Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to another episode of the Physician Sense Podcast. I am your co-host, Chad Chubb, joined by my bestie from the Northie, the one, the only, Tyler Olson. I wish you were out west. It would have been my bestie from the Westie, but we'll plug in Northie.
Oh, that's so cheesy. It's good to see you, man.
Good to see you.
Yeah, and I'm excited because we've got some more mailbag questions. We love your questions, you dear listeners. It's awesome to hear your questions because then we know what's on your minds like right now. So I'm excited. We're in the throes of summer right now, but by the time you hear this, it'll be fall. So I'm happy with the warmth, but I will also be very happy with the fall. It's July. Actually, today's the beginning of July, right? And so this is the moment during summer when I say, all right, I'm ready for fall, which I know that's weird, but.
Well, no, this is the moment for us individuals in the South that we think, oh my gosh, we still have like 3 more full months of hot, humid weather, followed by, our hurricane season's been like really bad September, October. I think my wife's birthday is a bad omen for Florida. We've only lived in Florida for 3 years. Literally on her birthday, 2 of the 3 birthdays that we've lived here, either a hurricane is very close to Tampa or like making landfall very close to Tampa. So September, October, and then my middle son's birthday is mid-October. He also has not had a good streak. So before we moved out here, everyone's like, oh, there hasn't been a hurricane in 100 years in Tampa. I'm like, great. Now we moved down here. It's like every year they're like, hey, here's one headed right at you. So I miss the days of the Northeast where this time of year, I'm like, oh, already starting to plan when I'm going to get my first pumpkin latte.
Mm-hmm.
Not down here, my friend. I'm just
roasting
for like months.
Yeah.
But we know what we're getting into. I can't complain.
Yeah. Well, you got a nice tan.
Thank you.
For those of you on YouTube.
Yep.
Yeah.
I just got back from my 10-year wedding anniversary trip without kids. So it was the first time I could actually tan in about 7 years. So thank you for noticing the glow.
Hey, congratulations. That's awesome.
Thank you. All right. I'll read the questions today.
Okay.
Student loan heavy, but with all student loan questions, that's why I love student loan planning. It really brings in numerous parts of the financial plan.
Mm-hmm.
So first one, a little bit more straightforward, but I know that this is a popular question out there. First one is this. Is PSLF still going to be available to incoming interns? Which I emphasize interns because as we chatted going live, that is a very important distinction there. Intern.
Yeah. The answer is yes, given the information that we currently have in the month of July 2025.
Yeah.
In line with the text of the bills that the House and the Senate have written and released, PSLF is not on the chopping block for anyone who is out of medical school. Mm-hmm. So if you're an intern, if you're a senior resident, fellow, attending, the rules for PSLF are fundamentally the same, even if some of the income-driven repayment plan options are different. And the payment amounts that you have to pay and so forth, those might be modified, or they probably will be. But at the moment of this recording, we are still in fluctuation in terms of knowing what those plans will end up being. But I am guessing that we're going to be looking at IBR and RAP as the 2 options in order to qualify for PSLF. But yes, if you're an intern, PSLF is a viable option. Is that pretty clear right now, right?
Yeah. And I feel like you're more in the student loan madness than I am. just based on your big audience through Twitter. But that's how I've been reading. I feel like, anyone, kind of my notes that I took here, still waiting for the big, beautiful bill to pass. I always remind people, remember the House was only a margin of one vote. So waiting for the Senate now. It sounds like 2026 is the sweet spot. Now, I think the interesting two parts are the $150,000 possibly limiting for professional studies, which would clearly have a major effect on the medical world. Although that most recent update was, what was this, late last week? Remember, we're recording July, so late June. The Senate parliamentary, where they said possibly you can't be forced into RAP, and then residents and fellows could also, that time would count. Which, and those are headlines, at least in the medical Twitter world, that have been scary. Kind of a little bit more context on the topic, but going back to the initial question, starting your intern year, you're in a pretty safe spot. If you're listening to this and you're starting medical school, in a few weeks, month here, I would be paying attention a lot more to what this could look like going forward. But as you said, as of July 1st, when we're recording this, we don't have final answers yet, which is why I feel like we've gone like literally months where we haven't done anything cool student loan based because we just don't know what to actually put in the episodes right now.
Yeah, no, it's like, we want to give you our best shot in terms of information in the moment. But yeah, if you're listening to this and what we're saying is like very different from what the reality is in the fall, just check my Twitter feed. It's going to be different. It'll be, I'll be updating there too. But yeah, that's something to go on for now in terms of longer term planning. But remember this, if you're in training, it's important to realize that even if whether you're going for public service loan forgiveness or not, being on a low cost, income driven repayment plan is probably the right decision just for managing cash flow. This is not time for debt payoff in most cases, unless you're married to someone who's got a high income and they're helping you pay down your debt. And those situations exist. You got someone that's got like $120,000 in student loans and their spouse is making $300K and you're making $60, and it's like, okay, yeah, maybe we can make a way to, pay this off early. But that is a very niche situation. So being on the RAP plan, if it actually exists, or IBR, is probably the right decision for most interns, regardless of PSLF. And then as you see where your career is headed and how much debt you have as you get done with training, and then what the layout of the PSLF options really is 2, 3, 4, 5 years from now, then you make your next move.
Yeah. Yeah. If we get any breaking news between now and whenever, I'm sure that'll be the next episode in line. We'll probably skip a lot of things and let that jump in there. So we're keeping an eye on it. Like Tyler said there, best breaking news, likely Tyler's Twitter. Just because we can't record that quickly, we still have full-time jobs outside of this. So yeah, we got to plan accordingly, but we'll definitely be on top of that once we get details. Even to show you context behind the scenes, Tyler and I even thought, should we do an episode on just the RAP, but just in case something changes, and likely something will likely change a little bit, or it's completely removed. Who knows? We don't want to go too far down that rabbit hole, but if it ends up being the new student loan plan, we'll be all over that one. So, all right, 2 case studies. I will read them. I will do my best not to fumble my words here. I will read them line by line. All right, so this one was unique. I'm interested to get your take on this because we actually didn't really go through what we'd say on this one. So here it is. I recently heard of a particular student loan management strategy for the first time. I'm in my 3rd year of an internal medicine-based fellowship, and my colleague is in his 3rd year as a hospitalist. The advice he followed is this. Note, this is for jobs that do not qualify for PSLF. And I would even add, this is Chad talking now, I would add a note, keep an open mind, even if you are going for PSLF, but maybe you have some separate private loans. Kind of thinking of the same way. Just they kind of overlap a little bit. All right. Continued back to his question. He was saying, even though the federal interests aren't as good as federal protections, so more or less rates versus protections, for the borrower can't be beat. So if wanting to aggressively pay them down, instead of privatizing the whole balance in a lump sum, you should do so incrementally, say by $30,000 or so at a time. Once it's paid off, move another $30,000 to the private loan. That way you get the best of both worlds. Never heard of this. Can you comment on why someone would recommend this? And what would be the right candidate for such an approach? So, in summary, individual has, say, $300,000 of student loan debt. They know they're not going for PSLFs. Let's assume it's all federal loans. They want to move over $30,000 in chunks to pay them off on the private side, to then keep 270 in our math here as a federal, because federal has better protections, maybe better rates too. I mean, it kind of depends, and then this way, only $30,000 is exposed to the non-federal side.
Mm-hmm.
I'm going to say question or our thoughts on this question, but even to add context, have you ever actually done this strategy? I haven't.
No.
Okay.
I'm trying to understand. The only benefit I can think of for this idea is that the interest expense would be lower. Because you can aggressively pay down federal student loans too. You don't have to refinance it to a private loan.
Mm-hmm.
You can make principal payments on your federal student loans.
From my side of it, it only makes sense really in one scenario. If you can get lower rates on the private side.
Yeah.
But now I think there's two hurdles. Hurdle one is refinancing $30,000 is a small amount. So depending on the loan term, now you should be able to get decent loan terms. Let's just say ideally you're paying that off pretty quickly.
Mm-hmm.
Not a lot of risk for the private. So maybe you do get a better rate. But then the only downside to this strategy would be, we're in an interest rate environment where rates are moving all the time. So while that could work last year, it might not work this year.
I guess part of it is it doesn't seem like an evergreen strategy. Maybe it works when rates are lower. But again, I think it comes down to one's capability of paying off the debt on one's income. If you're in fellowship, that's one thing. But I think this person's referring to someone who's not in training anymore. Someone who's an attending physician, so they have the ability to pay things down aggressively. I guess I don't really understand why you wouldn't just, if you're going to make a $30,000 refinance because rates are lower, why wouldn't you just refinance the whole thing?
So you could have some remorse if you're like, wow, that $30,000 got a 2% rate and you still have 7% on federal. And that's, again, the conversation we usually have with clients is you're definitely taking on more risk on the private side for most circumstances. Clearly, you want to talk through all of this.
Mm-hmm.
But if there's enough incentive on the lower rate, you're in a much better spot.
Right.
Because at the end of the day, if you get 1% lower on 30,000,
mm-hmm.
the actual savings per se is going to still be minimal. You're not going to see wow, I get 3% lower on this private loan. If that's the case, you're probably moving a lot over there. So to me, it feels like a lot of work for possibly little upside.
There it is.
And if there was a lot of upside, you could also get stuck kicking yourself in the butt that you left more in federal loans when the private loan was that much lower.
Mm-hmm. Yeah.
I understand it. I mean, I get the strategy. I just think most of our clients are, dual income, physician household, a couple kids running around the house. And instantly I start to think who the heck wants to do this with their free time? Hey, babe, third Saturday of the year or the month, I got to move over to 30,000, got to go through my application with Laurel Road and, get everything organized. I feel like it adds in a decent amount of extra work.
Yeah.
For maybe a little upside.
Yep, I'm with you. And even if you left some back because you're well, it's going to help give me some protection on the downside in case my income falls or something. Yeah, but I mean, I think that's a bit defensive. It's too defensive. If you're on a path to pay it off. And if you're risk averse in terms of your income potential in the future, I feel like this would have an impact on everything. I get the concern because it's well, I could fall back on the income driven plans if my income went down, if I became disabled or something. But I don't like taking that approach because it's like you're penalizing yourself to not move forward in a way. And it can, I know it's a disposition thing, but that's what disability insurance is for. That's why you get the disability insurance, because then that covers one of the biggest risks of losing your potential future income as an attending physician. So that's why we talk about it all the time and why you should contact Larry and Michael if you haven't done so. So there's a lot of ways that look at this, but it just seems like something it's just not worth the squeeze.
Yeah. Again, if we had all the context and we could run, the numbers, are there certain scenarios where, maybe you save a few bucks and keep better protections? I'm sure there are. I just think, at least based on the high level thinking, a lot of work for probably a little benefit. But hey, we're two pretty smart guys. We've seen a lot. Never heard of that strategy. So I will give his colleague, the hospitalist colleague, give him some street cred there. I haven't heard that one. So, all right, keep the party going.
All right, what's next?
All right, third-year medical student, currently around $250,000 in debt with more to come, unfortunately. My boyfriend and I are talking about timing of marriage. He has a full-time job, but does real estate on the side. We were wondering if there is a way around my debt reflecting on him on the debt-to-income ratio when looking to purchase real estate. If we get married before residency, we're thinking it would only be his income to my debt ratio. Is that correct? If you have other contacts, it would be greatly appreciated. So in a more general sense of the question, if I get married in medical school to a non-medical individual and go to purchase real estate, does the debt negatively affect our purchasing power?
So I remember a couple of conversations I had with our mortgage banker a few years ago. And basically, the variation of options comes down to who's on the loan. Like, you could be married to somebody and them not be on the loan, and then the underwriter will not consider their income or their debt.
Mm-hmm.
And if they're, so if they're not on the loan, then their debt is not under consideration.
Mm-hmm.
That's my understanding. So I think that getting married does not preclude her boyfriend from having the ability to purchase real estate, but I'm open to being wrong. What do you think?
No, I think that's where I was taking it. You will always have the choice, and this is just a good conversation piece to anyone listening or watching. You should always have your mortgage broker run both of you, assuming a married situation here, because even we get into credit scores, we get into debt to income ratios, like all of that's important. Now, in this example, I would like to think boyfriend's already working, doesn't probably have the debt in there, so already has higher income, doesn't seem like he has student loans. Assuming he has a good credit score, he's likely going to be the one listed on the mortgage. Remember, you can be listed on the mortgage as just one of you, but on the deed, both of you are still listed. That's another common question. Well, if I'm not on the mortgage, do I even own the home? Yes, you can set all that up appropriately. Calculations also vary by lender. Let's just say for some crazy reason that in this example, she has the better credit score for whatever reason, then the debt will come into play. It's been a while since I had to go through the calculation because there's just not a ton of mortgages in the current rate environment. But on the IDR plans, I know that most lenders will look at those in a more positive way. In the calculation, it's less heavy compared to maybe a private loan could be extremely heavy. So that's important to it. Some lenders are good with student loans, some are not. But in this example, should be able to get around that a few different ways. But most importantly, you both don't have to be listed on the mortgage. And I'd say most commonly, only one spouse is listed on the mortgage. I feel like it's almost always one.
Just one and not the other?
Yeah. I feel like I've seen that more commonly than both.
Really?
Maybe I'm just...
No, I mean, most of the time I've seen them, both spouses on it, but I have seen it strategically done where just one is.
Yeah.
So you can operate that way, definitely. I think it's workable, but I guess like one thing that I'm thinking about too with this person is that if he is into real estate already, he should be talking to lenders that he knows and asking them, because like lending requirements and things, they change, and neither, you and I aren't like in that world every day. So if this is your scenario, like, listener who's like sent this in and anyone who's also in a similar situation, it behooves you to communicate with the decision makers that are involved on the lending side. And like, tell them, be like, hey, like, I want to get married. Is this going to be something that's going to hurt my ability to borrow money to purchase real estate? Talk to them. But I think it would be fine, personally.
Yeah. Yeah. I instantly am like, you're probably going to have more planning that's going to need to happen on the student loan side more than the actual real estate side of things.
Mm-hmm. Right. Yeah, there's that too.
All right. I'm going to throw in a bonus one to this set because I already know the next setup for the last few.
Okay.
I think it kind of does a good job sticking with like medical residents and medical student theme. All right. So last one for this episode. I am an incoming resident at Mayo Clinic, Florida. What's up? Shout out. I wanted to know if there's a GSI disability option at this institution.
Yes. Yeah, there's a GSI program at all 3 Mayo locations. So if you're in training at Mayo anywhere, then you have access to a guaranteed standard issue policy. And this is such a good question. I'm glad that this came in because the 2024 Milliman survey came out not too long ago, and it affirmed that fully medically underwritten disability insurance policy processes they're rife with modifications and denials. I think it's north of 50% of applications are either modified or denied entirely. So I don't have the exact percentages up right now, but I think the modifications is somewhere in the vicinity of like 34% or something like that are modified, and then like an additional 17% or something like that are denied. So, and this is really important for you physicians because protecting your income is so important. If you are in training and your program, like Mayo, has access to a GSI, you can get disability insurance coverage, a $5,000 monthly benefit, and then up to a $15,000 monthly benefit once your income actually ratchets up after training without having to go through any medical underwriting. So, and you might think that you're really healthy and you're like, yeah, no, I'm good to go. But then you go through the underwriting process, and like something that your primary care physician wrote 4 years ago in a note gets pulled up by the underwriter, and they're like, oh, nope, modified, or nope, denied. And you're like, wait, what? I'm fine. I don't even know what that's about. And it's a real mess. There are many examples of this happening. So if you have access to a GSI, definitely prioritize that. If you contact either Larry Keller or Michael Relvis, they're agents that we've known for years. They can facilitate the Mayo GSI plans along with many others. And there's some GSIs that they don't have access to, and I actually just asked Larry a few days ago for Montefiore in Queens.
Yeah.
And he's not associated with that program, so he gave me the person's name over there. So we just want to make sure that you get that coverage. So whoever is covering a given GSI, we can help get you to the right people. But that's a great question. So yes, listener, you're at Mayo, you can definitely get GSI. And so that's very fortunate for you.
Guardians, right? That's Guardians the main one.
I believe it's Guardian, yeah.
Yes. Fun bonus question. Can you name where all 3 major campuses for Mayo are?
Oh, well, I mean, Rochester, and then Arizona.
Yep.
And Florida.
We're out in Florida.
I don't know. Where?
Jacksonville.
Jacksonville.
Yeah.
I think I knew that somewhere in my brain.
Yeah.
I filter so much out.
Well, it's also tricky because every time I hear Rochester, I naturally think of Rochester, New York, not Rochester, Minnesota. But
I naturally think of Rochester, Minnesota. But
really?
That's just because, well, I spent a lot of time in Minnesota as a kid, so it's in my head.
That's funny. Yeah, with us in Pennsylvania, my default. There's also there was an AHL hockey team. AHL is right below NHL, and we were from like Harrisburg, Hershey area.
Yeah.
And there was a team in Rochester. I think there still is, called the Rochester Americans. My dad and I did a road trip once up to that Rochester. My dad got lost. A typical stubborn male, refused to ask anyone for directions. Pretty much drove around Rochester for hours. I think their old arena was actually in the convention center. Some crazy facts for you. Now, again, Rochester, New York, nothing to do with the Mayo Clinic in Minnesota, but fun side facts in case anyone wants to win any like bar trivia. There you go.
Very cool.
Mailbag September 1 episode. I guess I should be careful dating those because if we get breaking news on the student loan front or on the tax front.
Right. I'm very excited about what's going to happen.
Really good episodes coming up.
Yeah. Yeah.
So excited.
Yeah. Things are about to get salty with the salt tax.
Oh, fun side fact.
Thank you very much.
New donut shop up the street. It's called the Salty Donut.
Right?
I haven't been there yet, but I might see how tax savvy they are, and I'm going to steal that one from you. Actually,
yeah, do it. That's
if they know it, and they're like, oh yeah, like, excuse me, I'll take 2 dozen donuts then.
Yeah. Although they probably don't because y'all don't have any state income tax down there.
Not a big problem in Florida. Well,
yeah.
Some can sneak over, but not like a California, New York issue. But anyway, my friend, love a mailbag episode. Love it even more with you.
Yeah, same.
We'll hit another one on this next episode here, but we'll keep the party going. Catch you on the next one.
Sounds good. See you soon.
All right, thanks, Alan.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Deals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state registered investment advisor.